Alright, good morning, good afternoon, all depends on when you're watching this video. So this is the beginner's guide to trading Forex. So what we're going to cover in this video is all the basic things a beginner should know. So as you guys should always know that there's always risk associated with Forex trading. This is why your risk management always plays a very big role. But we'll cover that in the sense of counting your pips, managing your lot size in line with your trading goals, etc. So we're going to start off with the basics. What is Forex? Connecting to the Forex market. What's a broker trading platform? So I'm going to do the trading platform in a different video, doing both on PC and the mobile. And then we're going to cover the basics, which is like support resistance, which is also supply and demand, identifying the trend, how to know whether the trend is bullish or bearish, chart types, the counting pips, what's lot size, time frames, stops and take profit, and obviously types of orders, and then trading styles, indicators, and the difference between fundamental and technical analysis, and obviously leverage and how you can make more money from depositing smaller amounts into your account. So what is Forex? So Forex obviously refers to the foreign exchange where one currency is traded for another. However, this term, don't mind the spelling mistake there, I'll fix it in the PDF. So the term has become very popular to describe the stock market as a whole. So when people usually say they trade Forex, they trade the stock market. So if you think one currency will be stronger versus the other, and you're correct, then you'll eventually make a profit. So the Forex market is basically the biggest industry in the world, the biggest market, and also has a value of $8.8 trillion trade on a daily basis, and you can get your share of that. $80 trillion, by the way, is about 70 trillion rand, and there's only 8 billion people on the planet. So connecting to the market, what's a broker? A broker works as a middleman between you and the interbank system, which is the World Bank. If you do on the SWIFT system, then you understand it a little bit better. If you don't know what the interbank is, it's a term but the first networks between banks. And if you read some more about that, you'll have a better understanding of how Visa, MasterCard, and so forth is the connector of all the other banks. So typically, a Forex broker will offer you price from banks and that have lines of credit that has access to the Forex liquidity. So a Forex broker is a link between trader and network of banks access to liquidity, like I just mentioned. Forex broker gives you access to the foreign exchange market and leverage to trade with it. They can also give you access to stocks and metals and energies. So before you start trading Forex, you should obviously educate yourself and also verify that you're trading with a verified and regulated broker. For example, if you sign up with a broker that's regulated in Australia, for example, that's fine. But if the broker is not regulated in South Africa and something happens, our authorities, it's outside of their jurisdiction to do anything about it. So trading platforms, many brokers use different platforms, but the most well-known platform in the industry is MetaTrader, created by MetaQuotes. They've been around for more than 20 years, and for almost 20 years. The trading platform is a technology solution which allows us as traders to actually execute the trades within a split second, unlike back in the day when you actually had to phone your broker. Someone captures your trade on a piece of paper, stands in a line, and then they phone you back to tell you that you either got in or out. So it's much more easier for us to actually trade nowadays. We are living in the age of information. Trading platforms usually allow traders to analyze the market and read data using different time intervals, as well as provide users with the tools to do in-depth analysis. Sorry about that, my network bugged out there for a second. So there's also alternative players who provide the technology to users, such as TradingView, which I love. They give much more sophisticated and advanced trading tools, which can obviously take it into the next level. I will cover the MetaTrader platform and also TradingView as we go along. So platforms can provide users with important tools such as the stop loss and take profit features, as well as risk management and exposure view. So the basics. This is where we actually get to the actual trading and reading the charts. So initially we trade from the support and resistance zones, but this is obviously a beginner's course. The more advanced things we teach, we cover highs, we call them highs and lows. But to understand it better, using what we all learned beginning from baby pups, support and resistance is one of the most widely used concepts in trading. Everyone has their own idea of how you should measure support and resistance, but let's look at the basics first. So basically how it works is, if price goes up and it hits a wall, it's called resistance, and if it bounces and it goes down and bounces, it's called support. So as you can see, wall is on this picture. This resembles what support and resistance looks like. So as you can see above, this is obviously a zigzag pattern making its way up. So this is called a bull market, right? If market goes up, it's called bullish, and if market goes down, it's called bearish. So when price moves up and then pulls back to the highest point reached before and pulls back now, it's called resistance. Resistance level indicates where there will be a great volume of sellers, and vice versa. Support indicates where there will be a great volume of buyers. So when price continues to go up again to the lowest point it's reached, it's now started back at support. And in this way, support and resistance are continually formed as prices move up and down over time. And this is how you can constantly make money on the market, because the market moves 24/5, or if you trade synthetic indices 24/7, or some crypto 24/7. So support resistance can also look like this, and what this is called basically is called the consolidation phase, where price will move sideways. This range can be either from 10 to 50 pips depending on the pair. In most cases, if the pair is like a very volatile pair and this range is like 100 pips, for 50 to 100 pips, you can easily trade up and down, and make 50 to 200 pips very easily. Now, as I explained just now, you have to identify the trend. The trend is your friend. You should never trade against the trend, if that makes sense, because you can, but it's not recommended, because you would obviously have to trade in line with the market makers. The people with the most money, they move the market. This is why the World Bank provides liquidity, because all the money in the world is stored with the World Bank. So there's three very simple ways. So there's three things the market can do. It goes up, bullish; goes down, bearish; or consolidates, which is sideways. In the bullish market, price continues to rise over a period of time, showing higher highs and higher lows, which means a higher high, a higher low. Or in British, so this is a high, and then the low is formed. Sorry. So when a low is formed, price then goes up. Sorry. Price then goes up, and then a higher high is formed. Price makes a new low, and now a higher low is formed. Price breaks the high again, higher high, and higher low. I can understand what that means. And vice versa, in the bear market, forms a low, then it forms a lower high, and then when price breaks this low again, it forms a lower low. Price breaks a little bit above, then it forms a lower high. I hope that makes sense. Now there is three types of charts on the market, and so make sure it's still recording. So there's three types of charts in the market, which obviously a line chart, a bar chart, and a candlestick. But because of its complexity, traders mostly use candlesticks, because candlesticks can tell a story. You can actually see what the volume does second by second if you felt in 1 minute, and they represent opening and closing times, and the highest and lowest points, and highest and lowest prices in a longer time frame. So we can use different charts to make different predictions about future movements. This method is called technical analysis, as the name suggests. This analysis is it analyzes the historical prices of assets. Now the first chart over here, we have a line chart, and as you can see that the true trend on this one. The second one, as you can see, with a bar chart, looks much more funnier, because as you can see, it's a straight line, but this typically measures the closes of the candle. These lines that go to the right and the left. The third one is what we mostly use. So me personally, I mostly use the line chart and the candlestick chart. So the third one is the candlestick. As you can see, it's candlesticks. So it has wicks. As you can see it properly. You can actually see it properly, as you can see. So how a wick works is, say this is the body of the candle, right? Now I understand that. So if, let's say this is a bullish candle, or let's say this is a bearish candle because it's red. So obviously then the opening would be on the top, because that's the anatomy of a candle. So let me just explain it again. Anatomy of a candle is a bullish candle would open at the bottom and close to the top, and a bearish candle would open at the top and close to the bottom. Makes sense, right? Now you would usually have wicks as well. As you can see over here, we have those wicks like that and like that, for example. Now what these wicks represent is where that candle has gone before the candle has actually closed. Now I will explain time frames in a second and you'll have a better understanding of these candles. Now how it works is, now let's say this candle opens and closes here. This wick here at the bottom represents the price has gone there, but it has went up. Price has gone all the way up there, but it closed over here, and same thing over here. Now the fourth thing we're going to cover here is just counting pips. Now this is a very important thing you should know, especially when it comes to your risk management. So take your time understanding this information. If it will help you trade on demo account on different lot sizes to see how the profits or the losses accumulate and how much it's worth based on the pips, right? So basically in life, in our everyday life, the currency value we have has two decimals. For example, the rand has, for example, it's 15 rand 68 cents. The dollars maybe $18.15 or whatever, now in forex we see 5 decimals. Depending on your broker, you might only see 4. I prefer a broker that gives me 5. Now for example, we see euro USD would be 1.25245, and GBP USD might be 1.35790, just an example. So in forex, the smallest decimal can make you money. Let's break it down. Now here's the other thing, P is whatever works for you, pips or points. Some people call it points, some people call it pips, whatever works for you. So let's say price is currently at 1.24130 and it moves through 1.24140. Price has now moved 1 pip. So like I said over here, but some brokers might only see 4, but as you can see, I prefer 5. Now if your broker only has 4, let me see if I can okay, it should work. Now say your broker only has 4 decimals. So as you can see, then if price moves from 1.2413 to 1.2414, price moved 1 pip. Or you can say that price has moved 10 points if you have a broker with 10 with 5 decimals. So let's look at another example over here. Price is at 1.24130. Now price moves to 1.24230. Now as you can see, the third decimal has moved instead of this one, right? Now as you can see, price has moved 10 pips, or some would say price has moved 100 points. And just to give you that idea again, if you have a broker with 4 decimals, it would look like that. So it would look like price has moved 10 pips. Does it make sense? I hope it makes sense. Now last example, say price currently at 1.24130 and price moves to 1.25130. Now technically in our everyday life, this is 1 cent, right? 100 pips, or some say 1,000 points. Now trading the smallest lot size in rands, or in dollars, if you catch 100 pips using 0.01 lot size, the smallest lot size you can use, and you catch 100 pips, you'll make $10. That's 150 rand. Now usually on forex, it takes about 1 to 2 days, 3 days, maybe 4 days, depending on the pair, to move that amount of pips. But with indices, you can do it in minutes. So volatility plays a very, very big role when you trade your pairs. Some people have favorites. I personally have favorites as well. As time goes on, you guys will see the pairs I trade the most, and obviously the pairs which pay me the most. By understanding how to count the pip, whenever you do analysis, you know exactly what lot size to use and manage your risk based on your stop loss in pips. So what's a lot size? A lot size is a unit measuring a transaction amount. When you place orders on your trading platform, orders are placed in lot size. Orders are placed in sizes quoted in lots. It's like an egg of cartons or a box of eggs. When you buy eggs, usually buy a carton of eggs a box. So you know a carton includes a dozen, which is 12 eggs. So same thing. A standard lot size is 1,000 units of a currency. Now there's also mini, micro, and nano lot sizes, which are 10,000, 1,000, and 100 units. And the mini, micro, and nano, that's where the risk becomes less and less and less when you trade. So some will show quantity in lots, while some will actually show the actual units. You know, it's recommended, or the way I've been doing what works for me is I like seeing the lot sizes. It's easy for me to actually measure my calculate my risk like that. Now, as you may already know, the change in the currency value is relative to another measured in pips, like we just explained, which is a very small percentage of a unit of a currency's value. So you can take advantage of this minute change in value. So for example, let's say price moves like 10 pips in say 3 minutes. If you trade a large lot size, you can make a significant amount of money or lose it depending on, obviously, your bias. So let's look at how our lot sizes can affect our profits. So example one, let's say we're trading Euro USD, and say we buy Euro USD with a 0.01 lot size with the entry at 1.25500 with its 10 pip stop loss and 50 pip take profit. So as you can see, the risk is 1 to 5. I'm risking 10 pips to catch 50 pips. So let's say price moves from 1.25500 to 1.25400. That is 10 pips, stop loss. So stop loss will cost you $1 because of the 0.01 lot size. So basically, by trading like that, then you trade at 10 cents per pip. 10 cents per pip. So then if price moves all the way, moves 50 pips to 1.2600, the take profit code will be $5. So let's take it a bit further. Say buy Euro USD with a 0.10 lot size, and same example as above, same numbers and so forth. Just because your lot size is now 10 times bigger, obviously, if price moves like that, from 1 point, okay, this should be 1.2500. I should fix that, but just bear with me. So if it moves from that amount to, wait, I made a few mistakes here. Let me just fix this real quick. Don't want to confuse you guys. Okay, so second example, entry is at 1.2500, 10 pip stop loss, 50 pip take profit. If price moves 10 pips to our stop loss, the stop loss will now be $10. As you can see now you're trading at $1 per pip, right? Like I said, over here we're trading at 10 cents per pip, $1 per pip, and the take profit then could be $50. So as you can see, your lot size plays a very big role in line with your stop losses. So let's take it even further. Say we buy one standard lot size of Euro USD, 10 pip stop loss, 50 pip take profit, and same entries is above in take profit. The stop loss cost will now be $100 and the take profit will be $500. So you see how much money you can actually make. So obviously, if you have a small account, you must start off with a small lot size, grow your account, and initially work your way up, where you can trade a full lot size up to 10 lots. So for example, if you had to trade 10 lots now, your stop loss will be $1,000, take profit $5,000. If you trade 100 lots, your stop loss will be $10,000 and your take profit will be $50,000. Hope it makes sense. Now, the last thing is time frames. Personally, I use 3 to 4 time frames to map up the market and decipher the long, medium, and short-term trend. Depending on your platform, you should see the following: M5, M1, M5, M15, M30, H1, H4, D1, weekly and monthly. So the M stands for minute, H hourly, D daily, W weekly, M monthly. Depending on each time frame that you're using, each candle represents a time interval. For example, on the M1, each candle represents 1 minute. On the M5, each candle represents 5 minutes. M15, 15 minutes. M30, 30 minutes. H1, 1 hour. H4, 4 hours. D1, 1 day. So what this means is for one candle to close on the M15, for example, will take 15 minutes. On the D1, for one candle to close, will take 1 day. On the monthly, it will take 1 month for one candle to close. Does it make sense? So that's part one for now. How if you have any questions regarding this, feel free to reach out to me. There's still a few things I want to go over and cover. The next, like I said, also after this, I'll cover the platforms and how you can actually do your analysis and so forth. I really hope what I explained you made a lot of sense. See you guys in the next video.